Today we're going to be talking about a real estate investment strategy known as the BRRRR method. Ryan here from Boselli Brothers Real Estate. The BRRRR method is an acronym that stands for buy, rehab, rent, refinance, and repeat. The first step of the process is the buy. The buy is important because this is what you are going to purchase your property for. Now this needs to be under the market value of other properties in the area. You might ask, why would somebody sell their property to you for under the market value of, say, a 3-bedroom, 2-bath house in that area? And the reason is because the property that you're going to be looking for is going to be distressed in nature. It's going to have bad exterior, the roof might be bad, foundation might be bad, kitchens, bathrooms might be outdated. All of these are value add opportunities in order to increase the value of the property. The next step of the process is our rehab. The rehab may be one of the most important steps in this process. Your rehab is going to take your distressed property that you've decided to buy, and it is going to turn it into the market standard to make it look just the same, if not better, than the houses in the surrounding area. Now, how do you know what the market standard is? You can do this by analyzing properties in the area that have recently sold at our retail value, that have just been rehabbed, and you can see what other people are paying for what type of product in these markets. Now, when you look for the rehabs, you're looking for value add opportunities, like I said. That might be adding a half bath to a pantry off the kitchen that is underutilized. Any value add opportunity, adding bedrooms, bathrooms, square footage, or fixing capital expenditures is going to be crucial in making sure your property appraises at the value that you want it to. The next R in the process is R, rent. Now, rent is before refinance because sometimes institutions want to see that your property is rented before they issue a refinance. This is especially true with LLC loans, which we can get into in a later video. Your rent is based off the market rent in the area, and you know what the market rent is in the area because you analyze that during your buy period, and that helps you construct your rehab budget to meet retail standards in your market. Now, you will rent your property, you will list it on Zillow, Realtor, all the major MLS websites, get your property rented for fair market value, and that brings you into your refinance. The next R in the process is R, refinance. Your property is going to be appraised by an appraiser. That appraiser will go out to your property and look at all of your wonderful rehab work and establish what your property is going to be worth. The bank will see this appraised amount and they will issue you a refinance at 75% of whatever that valuation comes back at. Now, ideally, your purchase price in your rehab will account for 75% of this number. That way, when the bank cash out refinance, they write you the check for 75% of what the house is worth. That covers your purchase and your rehab costs. And that brings us into the final stage, which is repeat. Once you have all of your capital back out from your purchase and rehab, you have a renter in the property paying down your mortgage that you now have from your refinance. You now have all of that cash back to reinvest into another property, rinse and repeat, and do this process all over again. Scale your business and grow wealth through leveraging debt and real estate. That's all for this video. Thanks, guys. The rehab was going to bring